All right, let's get right into it. Today, we are cracking the code on the language of business. We're going to take all that confusing financial modeling jargon and turn it into stuff you can actually understand and use.
You know that feeling, right? You're watching the news, they're talking about a company's earnings, and suddenly they're throwing around terms like EBITDA or DCF, and you're just kind of nodding along? Yeah, it really does feel like a secret language sometimes. Well, today, we're handing you the translation guide.
So before we can even get to the individual words, we need to know where they all live. And they live inside something called a financial model. The easiest way to think about it, it's the master blueprint for an entire business.
At its core, a financial model just tells a story. It takes what a company has done in the past, mixes it with some educated guesses about the future, and then projects where that business is probably headed. It's part history lesson, part fortune telling, all happening inside a spreadsheet.
Okay, so how do you actually build this blueprint? Well, every single financial model is built on a foundation of 3 core documents. You can think of them like a company's annual health checkup, where each one checks a different vital sign.
And here they are, the big 3. The income statement, the balance sheet, and the cash flow statement. Now, the key thing to remember is they aren't separate, isolated reports. They are all linked together. For example, the final profit from the income statement actually flows directly into the balance sheet. Together, they give you that complete 360-degree view of a company's health.
First up, the income statement, which you'll often hear called the P&L, for profit and loss. This one tells a story over a period of time, like a quarter or a full year. It really just answers one simple question. Over this time, did we make money or did we lose money?
Next is the balance sheet. Now, if the income statement is like a movie, the balance sheet is a photograph. It's a snapshot, frozen in a single moment in time. It shows exactly what a company owns, those are its assets, and what it owes, its liabilities. And it has to, always, follow that golden rule. Assets must equal liabilities plus equity. It has to balance. Now, here's a super important point. The income statement can show a big profit, but that doesn't always mean the company actually has cash in the bank. That's what the cash flow statement is for. It's the ultimate reality check. It follows the actual physical cash. It answers the question, forget profit on paper, where did the real money actually go?
Okay, so we've got the structure down. Now let's get into the fun stuff, the key metrics that everyone's always talking about. We're going to follow the path of money as it makes its way through a business, from the very first dollar of a sale all the way down to the final profit.
Think of this like a waterfall. You start at the very top with revenue. That's every single dollar that came in the door. Then you subtract the direct costs of whatever you're selling. That's COGS, and you're left with gross profit. From there, you subtract all the other costs of doing business, rent, salaries, marketing, you name it, and what's left at the very, very bottom? That's your net income, the famous bottom line.
And of course, you're going to hear the term EBITDA thrown around constantly. It sounds way more complicated than it is. Just think of it as a way to measure a company's pure, raw operational performance by stripping out the noise from accounting decisions and financing choices. It makes it way easier to compare the core health of 2 different businesses. You know, describing what a company is doing right now is one thing, but the real magic of a financial model is its ability to look forward. This is where we shift gears from reporting what happened to predicting what might happen.
And every single prediction starts with an assumption, or what we sometimes call a driver. This is the real engine of the model. It's where you put in your beliefs, like, I think sales will grow by 5% next year. That one little assumption then drives all the other calculations in the forecast.
So what do you get when you put all those assumptions together? You get the forecast. If your assumptions are the engine, the forecast is the destination it calculates for you. It's the part of the spreadsheet that paints a picture of what the company's finances could look like in the future, if your assumptions turn out to be right.
So why do we do all this? Why go to all the trouble of predicting the future? Well, a lot of the time, the ultimate goal is valuation. It's all about answering that $1 million or sometimes $1 billion question, what is this company actually worth, right here, today? And one of the most powerful tools for figuring that out is the discounted cash flow, or DCF. A DCF model takes all of that future cash you projected the company will earn and basically translates it into a single number that represents the company's value today. It's all based on a really simple idea. Money you get in the future is worth less than money you have right now. So we have the language, we understand the purpose, but what actually makes a financial model good? Well, that brings us to what is, without a doubt, the single most important rule in all of financial modeling.
And that rule is this: garbage in, garbage out. You have to burn this phrase into your brain. A model is only as smart as the assumptions you feed it. You could build the most beautiful, complex spreadsheet the world has ever seen, but if your inputs are based on bad data or just lazy guesses, your final answer will be completely worthless, period.
Here's a perfect example of how this rule plays out in the real world. A huge mistake people make is called hard coding. That's when you type a number like, say, a 25% tax rate directly into a formula. Don't do that. The best practice is to have a special section for all your inputs, and you link your formulas to those cells. It makes your model flexible, totally transparent, and way easier to check for mistakes.
And that's pretty much it. You now have the dictionary. This stuff isn't just a bunch of random jargon anymore. It's the actual language, the words and the grammar that people use to build, to analyze, and to tell the story of any business out there.
So I guess the real question is, now that you have the keys to this language, what are you going to do with them? What financial news will make more sense? What investments will you look at with a bit more confidence? What stories will you finally be able to unlock?